market structure has really changed. I think people in this industry are used to retail flows. And when retail flows, it's just like it slams in and it like slams out. And you're like, all right, I'm out, right? And you sort of like, you see this massive swing. That's not the way institutions work. That's not the way sovereign wealth funds work. That's not the way pensions work. That's not the way mutual funds work. What those guys have to do is
Bitcoin has finally bounced. The total crypto market cap is fighting to hang on to $3 trillion. Sentiment has improved from apocalypse to garbage fire. And now everyone is wondering, have we bottomed, or is this just a bull trap before a year-long bearish winter? Hello and welcome to the Milk Road Show, the daily crypto show that knows that when everyone is scared, it's a great time to get together and be scared in a group. Today is November 26th of 2025, and we are joined by Avichal Garg, co-founder of Electric Capital and chairman of the Crypto Council. It's great to have him back on the show. He is one of the most plugged in investors in crypto. He sees every major pitch deck. He talks to founders, investors. He's really got a front row seat to what's going on in this industry. We're also joined today by a friend of the show and fan favorite, Jesse Eckel, who's been on the show many times. Everyone in our Milk Road community loves him, so we're glad to have him back. Today, we're going to be diving into crypto market cycles, DATs, developer reports, what you need to know to prepare for 2026, and a whole lot more. This is going to be a great episode. We're going to have a lot of alpha in here. So if that sounds good to you, make sure you like and subscribe. Share this episode with someone who is down bad and needs to be up only. And as a reminder, before we get into things, we are kicking off our Black Friday offer early. For the next week, you can get up to 40% off on all access. That's crypto, macro, and now AI Pro, all in one membership here at Milk Road. Check out the link in the show notes to get in on that. Today's episode is brought to you by Bridge. Power your business with instant stablecoin payments. No friction, no banks, just global finance made simple. Blocktrust IRA, let AI outsmart the market and grow your crypto while you sleep. Reserve DTFs, get exposure to the entire crypto market in a single token. And without further ado, welcome to the show, Avichal and Jesse. How are you guys?
Doing good.
Awesome. Well, I'm glad to have you here. That's always an awkward way to introduce two people at once, and then both people have to say, I'm doing well. So let's maybe start with you, Jesse. Crypto feels stuck. Price action is stagnant. There's a lot of chop, a lot of uncertainty, confusion, frustration. What are your thoughts on where we are in the market, and what should investors be thinking about at this time?
Well, I've been pretty consistent that I think a lot of the issues we've been going through have mostly been plumbing issues that have to do with being the fact that we're in a late stage tightening cycle. So we've been tightening since 2022. Things got really choppy with the TGA rebuild, the government shutdown, and everything around that. Plus, we had the liquidation day, the huge liquidation event. And so things got choppy, and that's led to some really depressed sentiment. And it just all happened to coincide at the exact time when everyone's thinking it's time to exit because of the 4-year cycle. And so with all those things converging together, yeah, we saw a pretty big move down. But it doesn't change the bigger picture for 2026, which is we have the midterms coming up. Trump and Besson are flipping already into what I call midterms mode. They have a lot of things lined up for 2026, including changes to the ESLR. We have Powell out in May. We currently are sitting at like 80% odds. We're getting a rate cut in December. And so there's just a lot of stacked odds towards like more liquidity, more money flushing through the system. Plus, as we'll get into a little bit later in this episode, on the crypto side of things, I really don't think things have ever been more bullish. There is so the picture in terms of crypto is just absurd and kind of like bigger than my wildest dreams. And so a couple of those things together, I think 2026 is going to be a really, really good year. And I think a lot of people are jumping on this 4-year cycle bandwagon. It's like literally everyone. If you actually look at it, it's like everyone and their mom is like, oh my gosh, I perfectly timed the cycle, 4-year cycle. They're like planning on selling the next pump up. They're like, wow, we're just going to follow the old roadmap from past cycles. And it never works out like that. So yeah, I'm really bullish going into 2026.
Avichal, what are you thinking?
I'm thinking a couple things. One, I generally agree with everything Jesse just said. A couple of things I would add. We're not kind of by the nature of our business model, we're long hold on stuff. We tend to be early investors into companies and protocols, and then we're on that journey for 7 to 10 years. And so we're not traders and do a bunch of Bitcoin trading or anything, but I actually still think of Bitcoin and ETH and some of these top level assets as very long-term venture holds. Like when you start running the numbers on these things, like I don't know what happens in 26, I don't know what happens in 27, but you look at the macro backdrop and you look at the technical backdrop here, and it just seems to me that it might go up, it might go down, but 10 years from now, it's probably worth a lot more. And this is the sort of the digital gold narrative. And I think once you start putting numbers against it, it becomes real. I remember back in 16, 17, we used to talk to people and say, hey, one day Bitcoin's going to 1 million. And you could reason through that. You would say, hey, if it's 1-to-1 with gold, each Bitcoin's worth 400,000, and then you figure it might be a little bit bigger than gold, and 20% of the Bitcoin have been, the keys have been lost in Satoshi's coins, and so on and so on. And you could reason your way to like 750 to 1 million. Today, if you do that same math with the market cap of gold, each Bitcoin's already worth more than 1 million, right? So, just because gold market cap has gone up so much, right? And so I think over the long term, this is probably one of the easiest places to put money, in my opinion. It's not financial advice, obviously, but it's like, I think the long term is much. The takeaway is the long term is a lot easier than the short term, in my opinion. And the backdrop reason, which is again sort of like a zoomed out version of what Jesse just said, is if you think about the situation that most countries are in right now, the way the demographics are set up in almost every country, save maybe India and Mexico, you're going to have more older people than younger people. And what you have already is fiscal dominance. You have debt sort of coming on, and that becomes a major driver of kind of where money flows come from, is sort of the need to pay for these social services. And so you kind of have 4 paths going forward, right? Option 1, to try to figure out how to not just be under 200% debt and like sort of be stagnant for 20 years. Option 1 would be you somehow have to cut these kinds of entitlements in this sort of social spending, which is really hard because like you got to pick winners and losers, and no politician wants to do that. Nobody in a democracy wants to do that. Option 2 is you try to raise taxes, and raising taxes is actually extremely unpopular in most Western countries. And so politically also not feasible really to get done. Option 3 is you debase your currency, which is politically feasible. And so that's what actually everybody's going to do. That's what they have to do because the first 2 options are not viable. And option 4 is you grow your way out, which is hopefully you get productivity growth, which allows you to like support the debt load and sort of a rising tax base, even with fewer younger workers. And as a result, maybe AI and robotics and crypto like sort of let us grow our way out. So if you just look at that long-term backdrop over the next 10 to 20 years across like all of the Western world and China, it sort of seems to me like there has to be currency debasement, and that's kind of the only way forward. And so in that kind of the backdrop, I don't know how you can't stay bullish about crypto.
I appreciate that longer view. Yeah, right. There's a longer term view there. I think a lot of investors are really concerned about this month and this quarter, and I want to kind of get your guys' thoughts on this. It feels like right now there are 2 major camps, and you guys may differ, so if you have a different view of this, let me know. But there seems to be 2 camps. One is saying that the 4-year cycle is playing out as it always has in the past, and we are about to enter a year-long bear market. The other is saying that they believe in this sort of lengthening cycle idea, that we're going to have bullish activity into 2026. And it seems like there's evidence to support both theses right now, but the market hasn't really made up its mind yet. What is your thoughts on these 2 different views, and which camp do you guys fall in? Jesse, I'd like to start with you on this one. What are your thoughts on that? I think you're pretty clearly in we're going to have bullish activity in 2026, but tell me more about what do you think about these 2 camps here?
Well, the 4-year cycle in the past lined up perfectly with like big pulses in global liquidity. And so, and it's not everyone. I always point out everyone uses the normal global liquidity chart where it just goes left to right. What I'm talking about is year-over-year momentum in global liquidity. And if you actually just overlay that on the cycles, it's absurd. You can like see the crypto cycles on there, even though it's just tracking global liquidity. And so, really, I think those big risk-on environments are just a byproduct of that and that big flushes in liquidity. And right now, as I pointed out, since 2022, we've been in a tightening phase. And the longer you tighten, the more cracks appear in the system. And that's what you're seeing right now with all these things. It's like, oh, this credit thing, oh my gosh, we're worried about the carry trade unwind. And it's like every other week, there's some crisis somewhere. And that is those cracks in the system. Things have been too tight for too long. And it's forcing policy to go the other direction. And so typically a crypto cycle ends at the height of an easing cycle. It's when credit conditions are really loose. It's when there's a lot of froth. It's when everyone's bullish. Every other cycle has ended with everyone like mega bullish that, buy the dip. This is the only cycle where every single time that we go up, everyone's bearish. And it's just weird. It's not normal. A lot of the structural drivers of what's pushed up the market has been more market structure. It's been these ETF flows and the narrative around that. And as I pointed out with the stock market, it's been a lot of AI build out's been what's pushing everything higher. And so if you look at the wider economy, like it's in the dumps. It's not looking very good. And the Fed just kind of ignoring that. They're just saying, hey, they're cherry picking the data. And so with such a long tightening cycle, policymakers are forced to ease. And that's where we're headed. And we're headed in that, and I think it's accelerated in 2026 by the fact that we have midterms. And the only way the Republicans win is by making everyone feel rich. If everyone feels poor going into midterms, the Democrats will sweep. Like utterly sweep. And so Trump has one move, only one move, and that's to make everyone feel rich. And that's why he's pushing so hard for the Fed to cut. That's why he's pushing hard for these stimulus checks next summer. But also you have things like, some people are talking about balance sheet expansion from the Fed. And maybe that happens. Maybe the Fed's really loose at that. But the flip side of that is Scott Bessent's been talking about since early 2025, loosening the regulations around private credit. And so post 2008, we clamped down on the banks pretty hard because everything that happened in 2008. And so banks have not been lending like they were before 2008. But lending is a form of money creation. It's a private liquidity, right? So the Fed's been the one, QE and all the stuff that's pushing liquidity into the market. Well, Scott Bessent wants to say, take it back and say, hey, we want the private markets creating liquidity, not the Fed. And so that's where you have these ESLR changes and things like that. And so any which way you cut it, I think 2026, you're going to see a lot more liquidity flushing into the system, whether it's private markets or balance sheet expansion, because they have to. That is their only option. And so, yeah, I'm very bullish going into 2026 and possibly even post that.
It sounds like we're all going to be in that camp. Avichal, you tweeted that bull markets end on good news. You can respond. It sounds like you had a thought there, but I'd like to hear you elaborate on that that tweet. Bull markets end on good news. What do you mean by that? What is the thesis there?
Oh, I was trying to bait people. That was the day that NVIDIA announced really good earnings and the stock went down 3%. I was like, oh, this is a bad sign. So that's what it was intended to sort of get at more than crypto. But also kind of on the flip side, it was we haven't had kind of amazing news on the crypto side. So I'm kind of looking at that as like, you're climbing this wall of, to Jesse's point, everybody's just down all the time, and it's like generally actually good news, and you're like, okay, this is kind of weird. And so I'm actually looking for the inverse to happen, sort of just as a sentiment indicator, which is once everybody's like, hey, this is a new paradigm, this is going to be going up forever, like, it's game over, the institutions are here, yada yada, like you need that sort of thing to happen before you really are like, okay, this is the real top, in my opinion. Two things I would add to what Jesse was saying. I think on the top down Fed side, everything he said is right. I agree with, and I think the little bit of alpha is if you just go to Polymarket and you're like, who does everybody think is going to be the new Fed chair? It's like Hassett, Bessent, and Warsh, I think. And you can look at their public statements, and it's very clear what they would do if they were Fed chair and what they would push for. Now, there's like a board governor thing; you got to go to a bunch of votes and so on and so on. But I think, they're very clear on which direction they would land. And I think a strong Fed chair coming in, I think there's an argument that in conversations I've had with actually some of those folks that I know, it to me feels like the Fed has been split in a really weird way publicly, which is like atypical. Like you don't see them marching to the same narrative right now, which suggests to me that Powell has kind of like lost control of the situation. It's like a lame duck situation. And so whoever the new chair is that comes in kind of has to clean that up. And I think that's actually going to inspire markets, because it's kind of like markets don't like mom and dad fighting. And right now it kind of feels like the Fed there's like a bunch of infighting, and then they're kind of like fighting with the president a little bit, and they kind of don't want to cut just because the president is telling them to cut. And they're like, we're supposed to be independent, so we're not going to do it just because you said to do it. It's just like markets don't like that. And so I think that not only will sort of the policy change, but I think like the temperature will change with the new person, because the relationship with the president will get reset. And I think the relationship inside the Fed will get reset a little bit. And I think that's actually going to be really confidence inspiring for markets. That's the top down. I think the other thing to think about from more of like a market structure perspective is the market structure has really changed. I think people in this industry are used to retail flows. And when retail flows, it's just like it slams in and it like slams out. And you're like, all right, I'm out, right? And you sort of like, you see this massive swing. That's not the way institutions work. That's not the way sovereign wealth funds work. That's not the way pensions work. That's not the way mutual funds work. What those guys have to do is have an allocation target, get it through an investment committee. That takes 6 to 12 months, right? So we're like 18 months after the ETF, but it's going to take like a year to 2 years for a bunch of people to say, oh, we got to do this. And then the question is, what do you do? Oh, I have like a 50 bit target. So now I'm going to leg into that. And then if the price changes, my exposure changed, I got to add more, right? And so I think there's an argument here that the market structure itself has changed in terms of how the money will flow in and who it's coming from. And that bid is a really different bid. They're not going to slam, their entire stack in because they see it's going up and it might go up another 2x. They're going to DCA in and come in slowly. One analogy here is if you go back to the gold markets when like GLD was launched 20, 25 years ago, I'd have to go back and look at the numbers, but it's some crazy stat. The Bitwise guys told me this once. It's like the first 12 years of the GLD ETF, every single year had more inflows than the prior year. And so there's just sort of this like structural rotation needs to happen when institutions come in, and the way that they come in is really different than what people are used to. So I think there's an argument that the inflow really changes the 4-year cycle because the market participants fundamentally underneath it all have changed now.
Stablecoins are the biggest use case in crypto right now, but let's be real, using them on chain is still way too complex. That's exactly the problem Bridge is solving. Recently acquired by Stripe, yep, that's Stripe, Bridge helps businesses send, store, accept, and launch stablecoins instantly. Explore the future of global financial infrastructure at milkroad.com/bridge.
Bitcoin changed the investment game. Now AI changes the strategy. Crypto's wild ride demands perfect timing, selling before drops, buying as it climbs. While most investors panic, sell, or hope, a select few leverage a crucial edge: AI. Blocktrust IRA's trading platform spots market patterns with precision no human can match. Since 2020, their Animus AI platform has outperformed Bitcoin by over 250%. Visit milkroad.com/blocktrust today to get up to $2,500 in bonus crypto and transform your investment strategy.
Yeah, and now that there are different market participants, there's going to be different market behavior. Guys, really helpful thoughts on all of these things. I'd like to move on to the next crisis. There have been reports that MSCI might change some of their rules to say that companies that are holding more than 50% of their assets in one asset are funds, not companies, and that they might remove some of these digital asset treasury companies from their indices. Avichal, I'd like to start with you. What does our audience need to know about this? How might this impact digital asset treasury companies? Could this lead to a bunch of forced selling, or is this sort of a nothing burger? What are your thoughts on this situation?
I think mostly a nothing burger. Probably the only one that it might impact is MicroStrategy, just because they're so large that they're actually included in a bunch of these indices. And so to me, it feels like maybe MSCI is getting ahead of potentially other guys getting so big that they have like a forced inclusion problem. And so they're changing their policies in advance of that. Practically speaking, I think very few other DATs are going to be included in very few meaningful indices. And so I think it probably is a nothing burger from that perspective.
I was going to ask, do you think that this is like there's a bunch of tinfoil hat stuff going on about this, saying this is like a coordinated attack by these institutions against MicroStrategy, and that JP Morgan has announced that they're going to be launching Bitcoin-backed bonds, which kind of competes with some of the preferred offerings from Strategy. Like, do you think there's anything to that, or is that just like kind of like conspiracy theory nonsense? Like, what do you think of that idea?
No, I actually. I think it's hard to be in this industry and not be a little bit conspiratorial. Like, it's like every time you're like,
it feels like an attack.
Well, the whole thing exists because like some anonymous guy wrote a white paper on the internet, right? And like for all we know, that was the NSA, or who knows, right? And so it's kind of hard to. And if anybody knows the history of cryptography, right? Like you go back to, I don't know if you guys know this. What was the company called? It was a Swiss company, but I think it was literally called like Crypto AG. Do you guys know the story? So like after World War II, like the world's cryptographers, the Enigma machine happened, and sort of you got like first gen encryption. And so after World War II, all the governments of the world were like, hey, this is awesome. We can have encrypted communication. So now we could like have our generals on the front lines and talk to them, or we could have like our spies overseas and like communicate with them. Or we could like communicate with our embassies. This is awesome. So there's this company in Switzerland called, I think it was called Crypto AG. Yeah, it's like AG being like ink or whatever. And so we'll just call them that for now. And they were like the world experts at making cryptography and like encrypted communications devices, basically. And then the CIA secretly went and bought them and put in a backdoor. And so then they were just like listening to like all the governments of the world's communications. So like this whole space is like, you can't be non-conspiratorial and end up in this space. Like there's just so much history with this stuff. So I don't know. I kind of look at it and I'm like, you know what? Like I could totally see these, it's like the person who's deciding the policies at any index place went to college with the other person, or is like roommates in Manhattan with like the guy who's going to do the, the bond offering from JP Morgan. And it's all kind of incestuous. And they're like, everybody's sort of, that's how that whole world works, which is why I think DeFi is so interesting, right? It's like transparent and composable. And like, if I have liquidity, I can come in and I can see what's going to happen. I can see where the fees are going to, and that's like kind of the whole promise of the whole thing, exactly for this reason, right? There's like two buddies that like, were best men at each other's weddings. And he's like, hey, I'm gonna make a bunch of money if I can do this like MicroStrategy thing. Can you like hook me up, make sure like we cut off the demand over there, or like don't take their business next time, like take my business. That's kind of how that world works, which is what is like frustrating to so many people about it, because it's so incestuous and blocks people out. So I don't know. I'm kind of in the camp of, yeah, probably.
Yeah, there's something to that. Jesse, I'd like to get your thoughts on this from a bit of a different angle. Digital asset treasury companies have been very bullish in general for the space. There's been a lot of attention on that and capital going into those products or those companies. But there has been some concern about these digital asset treasury companies having to sell in certain market environments. A few of them have made moves and done that to defend their share prices. Is that something you're concerned about? Is that like an existential threat to the digital asset market, or is this kind of another nothing burger that's overblown? What are your thoughts on some of this?
I think whether it's the indices or them having to sell or whatever, like DATs are one investment vehicle, and they're really going to be a small fish in the grand scheme of things when it comes to, for one, you're just talking about the institutions. And that's a really valid point, that most of these ETF flows are not institutions. They are boomers. They are boomers buying via their, investment advisor. Okay. That's like $86 trillion worth of wealth that crypto is now tapping into, that they're just dipping their toe in, but that exposure is going to keep going up. Till some point, it's not going to, it's not going to go all 86 trillion, but you get the idea. Like that's a huge on ramp of capital. And so, and like you mentioned, earlier, or like we talked about earlier, they don't buy, they don't know about the 4-year cycles. They're not thinking about anything like that. They don't know about they're not thinking about DATs or anything like that. Their investment advisor is just like, hey, do you want to have some Bitcoin exposure? And they're like, yeah, we'll do 3% or 5% or whatever. And so you have those ETF flows, which are slated to grow year over year over year. And if you have seen that chart that he was talking about, it's absurd. It's like the inflows go like parabolic. It's like a Bitcoin chart, but for ETF gold inflows. And so, and that is what's typical. So you can expect year over year those ETF flows to go up. And I think if you were to cut off everything else, right? Liquidity, bullishness about the Fed, changes the ESLR, all that kind of stuff. You could be bullish on just the single fact that these ETF flows are going to grow year over year over year over year. But on top of that, institutions are really slow. They're really, really slow, absurdly slow, years. Okay. But that is going to keep ramping up. And we just saw that with, like you talked about with JP Morgan, where they're doing, all this, I don't know, the Bitcoin bonds or whatever. That's just another new product. But you're going to see so many of these products, so many of these new on-ramps, so many new like solutions here and banks offering this, or, institutional clients offering that. And so all of that, I think, is just this mega whale. And then you have like this minnow of like the DATs, which like maybe they survive, maybe they don't. But like there's so many other vehicles that I really don't think it matters.
Avichal, I wanted to bring you in on this too. Electric Capital partnered with ETHZilla, which is a digital asset treasury company, to help manage and deploy their ETH. There was a lot of attention on ETHZilla when Peter Thiel took a significant stake in the company. And so it's clear that these digital asset treasury companies are attracting a lot of attention from investors, not just boomers in their retirement accounts. So tell me more about this story on ETHZilla. What differentiates this from other ETH DATs, and what's the unique offering here that got a big investor like Peter Thiel interested in this? And yeah, tell me more about that relationship with Electric Capital there.
Yeah, totally. So we so a couple of things there. So we're also we're investors in ETHZilla. We're investors in Tom Lee's BMNR. We're investors in SBET with Joe Lubin. So we've done a few of these. We did some on the Solana side. We helped some of the other ones get off the ground. And kind of the way we thought about it at a high level was kind of similar to what Jesse was saying. It's just like, this is another piece of infrastructure and plumbing for another part of the market. And the ability to have those capital inflows come into this space is strategically important and valuable. And so if we can facilitate that, that's good for the space. It's just another part of the market that can access this exposure in some direct or indirect way. So for example, if we can get Bitcoin and ETH and Sol and a bunch of these higher quality assets to be considered valuable collateral, and then the debt markets are willing to lend against them, you've now unlocked an entirely new market. Not just for like the public markets with a DAT, but like now all of a sudden you can actually go to like a Goldman or JP or your local bank and say, hey, by the way, I have some assets, like, will you lend against this? Right. And that's just like doesn't exist right now. And actually that's a valuable thing. So that's at a high level, the way we thought about it is like, look, this is a structurally important thing to try to figure out how to get different parts of the financial system to flow in here. Then the question is, okay, well, what's going to differentiate these things? And I think there are going to be basically 3 strategies that people try to take. Strategy 1, I would call like the Tom Lee strategy or the Michael Saylor strategy, which is you're a zealot. You're going to say this thing is the only thing that matters. And you're going to make so much noise in the media that you're going to get this sort of retail bid. And if you get the retail bid flywheel going, every now and then for a short period of time, maybe it's a month, maybe it's 3 months, maybe it's 6 months, you're going to trade above the net asset value of your assets on your balance sheet. And when you do that, you can print more shares. So you can print shares for $1.20 or $1.50 for the assets that you have. And so in an accretive way, you can go buy more assets on the balance sheet, and there's this sort of flywheel there. That's sort of strategy 1. Strategy 2, I would sort of put into the SBET kind of camp. And I think some of the Solana ones are doing this too, which is you're going to have some collection of really productive assets that are thematically connected, and you can use that underlying asset productively in that ecosystem. And so I think the Joes over at SBET have done a good job of sort of tying in Linea. There's because Joe Lubin has consensus, so you can imagine like MetaMask tie-ins and consensus tie-ins, and so they're doing a good job there, and sort of like creating a flywheel with like, hey, we have this almost like permanent capital vehicle with ETH, and we can sort of create a flywheel there. And so I think you'll see that model is like option 2, which is we're going to tie in a bunch of operating stuff here, and the ETH is a useful piece of that. That may also happen through acquisition. You can imagine that like people start rolling together companies security companies, audit companies, staking businesses. There are all these businesses that it's really hard to make them publicly traded companies, but like in aggregate together, especially if you have like a permanent capital base, it could be really effective. And then 3, I think you're going to see people that say, hey, this is a set of assets on top of which you can generate very significant yield in addition to the operating business. And because of a function of the size, you can have really outsized yield performance. And so this is the approach that ETHZilla is taking. And so we're just the asset managers on that. So I'm not on the board or in the operating company at all. But there's a lot of stuff you can do if you know what you're doing on chain to be able to generate outsized yield. And so I think the numbers that were announced at the last earnings call were, I think, I have to go back and look, but I think it was like 7% annualized yield. And so when you start comparing that to sort of ETH exposure in an ETF, you look at it and you say, oh, this is better because we're not constrained the way an ETF is constrained, because the rules around ETFs are very, very tight, right? It's like, yeah, you can stake, but there are a bunch of rules about what you can and can't do. And we don't have those, right? So we can use that ETH productively. And so if there are parts of the market that are strategically important, like we set up a strategic tie-in with like EtherFi and Puffer on the LST side. There's some other interesting ones in the works. And so we can start to move that ETH around on chain to help facilitate parts of the ecosystem and really supporting them. So I think that'll be the 3rd strategy. So even this idea of like a DAT, I think when you start poking into it a little bit, there's actually different strategies that people will have. And hence, as an investor, you sort of look at that and you're like, okay, even if I have ETH exposure, do I want something that's like generating outsized yield relative to just holding the underlying asset and the staking? Do I want some sort of like operating business kind of exposure in addition to the ETH exposure directionally? And do I want to take this bet that this person is going to run this like retail flywheel the way I think Tom Lee's just put on a masterclass over the last year on how to do that? But they're actually, they're all called DATs, but they're actually, I think, different strategies.
Yeah, and I think that that's really helpful to hear that spelled out because they're not all created equal. They're all on different assets. They're using different strategies. And this is one of the reasons why at Milk Road we've been focused on this, because there's a huge education piece that goes into this for investors to just understand this. And it's one of the first times that we've seen real institutional capital get access to DeFi and see how that plays out. So I wanted to kind of use this as a pivot point into something else. Electric Capital is perhaps most famous for its annual developer report detailing development activity in Web3 and in crypto. A few days ago, you made an announcement that you're going to be sharing this data a little bit differently this year. I'd love you to tell our audience about what changes you're making, why, and just like what they can expect from this year's developer report. Because this is what I always know Electric Capital for. This is the thing I always read really closely every year. So tell us about that.
I appreciate the tee up. Yeah, we've been doing this since I believe 2018 is when we first started it. And so back then, when we were first getting off the ground, the thing we were wondering, again, just as long-term venture investors, Curtis, my co-founder, and I were kind of kicking around the idea of like, well, where does like fundamental value really accrue? And so we said, you know what? I think that where the developers are spending time is a really good signal. And it's a proxy for where is there interesting value that will be created over the next 2 to 5 years. There's that saying, I think it's a Chris Dixon saying, but don't hold me to that. But I'll credit him anyway because he's brilliant. I think Chris said something to the effect of what the software engineers do for fun on the weekends is what you'll do for a job in 10 years. And I think there's a lot of truth to that, right? And so we said, oh, we should go figure out what the engineers are doing. Where is that activity? And then we said, okay, well, where is that? Like, how would we even figure that out? And we said, oh, that's probably on GitHub and GitLab. Like if people are just checking in code into their repos and it's like affiliated with whatever ecosystem, or it's a toy project or it's a hackathon, there's like signal there. And so we built a system that could sort of crawl a bunch of sites, including GitHub and GitLab and a bunch of social media sites, and just try to figure out like where are real developers actually spending their time, and where's their code. And so we fingerprint something like, I think at last count it was like 750 million lines of code, like unique lines of code, and then we can tell you like who wrote that code first. So there's like a lot of copying and pasting that happens and forking and stuff, and so we can trace it back to the original. So we built a pretty robust data pipeline and data system that sort of tracks this, and it's just always crawling the internet to get all this data. And then once a year we would share it sort of with our Electric developer report. What started to happen last year, with last year's report especially, and a little bit the year before that, so 23, 24, was we started to realize that it was getting really hard to figure out where things belonged and how to kind of classify these things. Like, are L2s part of Ethereum? Is Aave part of Ethereum? Because they also have deployments on these other chains now. Like, how do you count that? And like, how do you sort of do attribution of, well, these two developers only wrote code for SWI and these two only wrote code for ETH or for this L2. And so the attribution problem became really gnarly and the methodology got really, really tricky. And you could look at a bunch of data and sort of interpret it two different ways, and depending on kind of how you wanted to sort of position it. In addition, to try to sort through all of that, we were spending more and more time with the foundations. So we spent a lot of time with ETH Foundation, Solana Foundation, Near Foundation, go through like the top 10, top 20 foundations, and a lot of teams in those ecosystems. And so really, I mean, if you look at the contributor list, I think it's at this point like several hundred people have contributed to the repositories that we have and to the data structures that we have and the taxonomy that we have. It's probably approaching like 1,000 people have contributed, which is pretty remarkable. It's like a good community effort. And so we were looking at that and we're like, man, this just gets so hard to even figure out where the lines are. And then as somebody that's sort of sitting in between, are we really the right people to adjudicate like, hey, this protocol should go into Solana or this protocol should go into Ethereum, or how do we even think about that? And so we said, you know what we should do? We should just hand it over to the community. Like, we'll open up the data. People can run their own queries on it. And then if they think that the analysis says a thing, like publish the data, publish the analysis. Because the data is open, anybody can go verify it. And then as a result, we can have an open conversation. And so now what you've done, hopefully, is get all of the foundations or any developer or any data person out there that wants to go like poke around in the data to go poke around with it and publish their findings. And then as a group, as a community, we can say, yeah, I agree with that, or I don't agree with that analysis, or hey, I would classify these things differently. Rather than us trying to be the arbiters of all of like, where do these different things go? So we open that up. It's called Open Dev Data. If you go to my profile on Twitter, you probably see a retweet on it or somewhere, or the Electric profile, the Electric Capital Twitter. It'll be up there. And so, yeah, it's available now. So we worked with the Ethereum Foundation to publish some stuff, and they did their own analysis on top of the data. We're working with basically all of the other major foundations to sort of publish their own data and see what they find. And so, yeah, it's sort of it's a little bit of an exit to community, but without a token. we don't want to everybody. So anyway, the data's there. If anybody wants it, go, come find us, and we're happy to share the data and would love for people to do analysis on top of it.
I love hearing that backstory on that and just knowing how it got to this point. And I love the idea of giving the community's data back to the community. Really, really helpful to hear all of that. Jesse, I wanted to bring you in on this. You perhaps more, well, I think a lot of people do this, but you stand out to me as somebody who does a lot of deep dive research on altcoins that are maybe falling through the gaps or getting overlooked. I'm really curious how you think about developer activity when you're evaluating projects or investment opportunities in Web3. How much detail do you go into on these things? How much importance do you place on this? What are your thoughts around developer activity as a factor in investment decisions?
I think developer activity is like the single highest signal that you can get in terms of like, especially when people are like, hey, you're never going to get like an alt season again because they'll say there's too many tokens. And my argument against that would be like, if you actually like boil it down to like real teams building like real products, there's like not that many. There's not that many in crypto. Like there's not millions, not like everyone's saying. Those are like meme coins. There's like I don't know how many there would be, but I imagine those kind of signals will be higher and higher value as time goes on. Especially because when you do have a lot of dilution of tokens, you need sort of a way to sort them because you can't just like YOLO into, you know what I mean? Like there's 5 tokens, you could buy all 5. If there's 1 million tokens, you cannot buy all 1 million, all million. So you have to start like differentiating them. And so I think developer like quality and activity is one of those things. And so when I'm looking at a project, I definitely like to reach out, talk to the person behind it and just kind of see how smart they are, like what's their background, what's their experience. Because, sometimes for me, when I'm like betting on some of those tokens, it's really hard because most of them are nonsense. Like 99.999% of them are just vaporware. And so you really have to find somebody who's talented behind the scenes who like just randomly happen to have, has a token. And that's becoming harder and harder these days because a lot of those tokens, do a traditional like VC launch. So I think that's critical and super important.
ETFs provide investors with a structured, disciplined, and diversified approach to crypto, which is cool, but the world is moving on chain. We need a crypto native equivalent. That's exactly what Reserve's decentralized token folios, DTFs, bring to the table. Reserve DTFs are rule-based baskets of crypto assets packaged into a single token, like CoinMarket's CMC20, crypto's version of the S&P 500. Go to milkroad.com/reserve to find out what's on offer.
Yeah. Okay. So I wanted to kind of bring all these things together for a conversation about innovation and what you guys are excited about that's happening in crypto and going forward from here. I want to start with Jesse on this. At Milk Road Macro and at Milk Road in general, Milk Road AI, Milk Road Crypto, we've been focusing a lot on this intersection between crypto and AI. And we've written pro reports on this for our community. So if anybody wants to read those, I highly encourage you to check those out. But I'm curious what you're seeing happening at this sector, because it seems like it was kind of one of those things that you're saying there's like a million different projects, but they're trying to figure out product market fit. And I'm curious about what you're seeing at this intersection. What's got you excited? You don't have to plug a specific thing. I'm just saying, like, people are trying to figure out what that intersection looks like. What are your thoughts on that space right now?
Most of the crypto AI projects that I come across, like 99% of them are just stupid. they're just nonsense. It's like somebody
they're pre-revenue, please.
Yeah. But obviously AI is like going to be the single most transformative technology yet. Like I'm a believer in that. I think people are crazy that don't believe that. They're like trying to compare it to railroads and stuff. And I'm like, you guys have lost your minds. I think the problem is most people use like the base models. They'll use like ChatGPT 5.1, or they'll use like, like the free models. Once you get up to the higher end models like GPT Pro, DeepThink, and some of these other ones, it's crazy what they could do. It actually blows my mind. And so, yeah, I definitely see it being transformative. I'm sure it's going to intersect with crypto. There are good projects that are trying to do that. I'm not saying there isn't, but it's just like anything in crypto with the metaverse or whatever. Like the vast majority of them are going to be tacking onto that narrative to kind of try to pump their token. But yeah, there's gonna be huge disruption and huge innovation eventually as time goes on.
Yeah. So watch that space. Avichal, I wanted to bring you in on this question too. You're the chairman of the Crypto Council for Innovation, which is something I think does a lot of great work, but that most retail investors don't really know anything about. Give us a little bit of a high level view of your role here and what innovation are you seeing in crypto that you're excited about?
Yeah, so CCI is an advocacy group and an education group. It's Electric Capital, Andreessen Horowitz, Paradigm, Fidelity, Block, PayPal, SoFi are on the board, and then I'm chairman there. And then we have a bunch of foundations and protocols that are members, and we focus on both state, federal, and international advocacy. So we spend a lot of time with the regulatory bodies. Spent a lot of time in DC working with the legislators and their staff, so senators and Congress people. And a couple of years ago, it was mostly just education. It was like, hey, let's just explain like what is a stablecoin and why does that have national security implications. Increasingly, because of a lot of the good work of the team there, G. Kim is the CEO, Sheila Warren was the prior CEO, but the policy team there is really, really top notch, and so it's like a serious policy institute. And so they spent a lot of time with the staff on the Hill, and I think we're very instrumental in helping a lot of the key provisions in the stablecoin bill. They're working very closely on market structure right now, and answering some of these questions about like where do we draw the lines between what is and isn't a security, or where does the SEC have oversight, where does the CFTC have oversight, and how can we have clarity for developers and builders in terms of what is and isn't allowed, and how do we try to structure that in a way that allows us to have good innovation and empower developers. And so things like developer protections are an important part of that too. So you can't we shouldn't be sending people to jail for writing code. Like I think that would be a bad precedent to set. And so trying to work some protections on that kind of stuff. So it's pretty gnarly, like really in the weeds legislative stuff, but really important to get right, because that structurally then is what determines who wins in the space ultimately. And you don't want to create a system where like the big banks just come in and win again. I think that would be sort of a huge miss. So it's really important work. It's a lot of behind the scenes work. It's a lot of just like grind it out, have one-on-one conversations with people. I will say probably, when I started doing this stuff about 3 or 4 years ago is when I really started engaging around policy stuff and just spending time with senators and their staff and Congress people and their staff and the White House and stuff. And I think a lot of people look at the state of things right now, like in DC or wherever, and they might be disappointed or dismayed. I've actually become way more optimistic having engaged here. So I'd actually encourage people to engage, because the thing I realized was when everything is 50-50, like everything is like so polarized that you're like, right, everything's just split down the middle. All you have to do is convince like 1 or 2 people. And then all of a sudden everything tips. And that's a way more tractable problem than actually like, how do I make sense of like, if everybody's kind of in the middle, how do I get everybody to converge on a thing is actually harder. When everything's like polarized, actually, all you need is like 2 people to flip over. Like you kind of saw this with the Epstein files. Like once Marjorie Taylor Greene was like, F you, I'm gonna like vote the other way, then it just tipped, right? And a bunch of people all cross the line and they're like, it's over. And so it actually made me really optimistic because that's a tractable problem. Like you can go have lunch with somebody on somebody's staff and like walk them through why they need to do a thing like rationally. And this is the reason it works, I think, is it turns out for all of the like, egos and grift and self-interest and all of that kind of stuff that you see with politics, there's still enough good people that care. There's still enough people where if you go talk to them, they'll be like, oh yeah, this is actually really important for like U.S. national security, for example. So like, let's take something like stablecoins. Like I literally had lunch with somebody who later became a senator, and the conversation we had was like how to think about stablecoins. And this person is a veteran. They were in the military, and they're a Democrat, and they switched their vote. Like then we had like a SAB 121 vote, and we had a stablecoin vote, and they flipped. And it's because they like sat down and tried to understand the thing, and like once they got their head around what stablecoins are and like how the U.S. dollar is really important in the world, they switched their vote. And so I don't know, for me, it actually, the process has been extremely empowering. I'm like, holy moly, actually, you can go have conversations with people and they'll change their vote because there's still enough good people in there that all you have to do is like find 5 of them and then convince them. And finding 5 people and convincing them over lunch or dinner over 6 months is like a totally doable thing.
I am really inspired to hear that and encouraged in a lot of ways. And I do want to just ask the second piece of that question again, which is like in crypto, in Web3, what innovations are you seeing that you're like really excited about right now?
Yeah, there's so many. So one of the things we thought about when we were starting Electric, we were very deliberate in picking the name. So we didn't call our firm Block something or Chain something, right? Or Token something. And that was a deliberate decision because our belief was that 10 years from starting, right? So somewhere by like 2028 or 2030, all of the technology would just fade into the background. Like you wouldn't even call it crypto anymore. you wouldn't even call yourself a crypto company. It's sort of the analogy here would be if you went back to 2010, you might have called yourself a mobile app company, right? If you're Instagram, like that might have been like in your pitch deck, you would have been like, oh, we're a mobile app that does XYZ, kind of the way today people are like, oh, I'm a crypto company that does XYZ. And at a certain point, you just say, I do XYZ, right? That's just like the first part of it goes away. You don't need to lead with that anymore because like, well, yeah, of course you would be. And so I think we're getting to that point now where if you're a fintech, like, why would you not use stablecoins? It's just strictly speaking better, right? So now you don't need to say I'm a stablecoin company that like does, reinsurance, or I'm a stablecoin company that does like payments for remittances between UK and Africa. You're just like, no, I just do remittances. And when you probe into it, you're like, oh, you use stablecoins. That makes sense, right? And so if you look at it through that lens, I think there's actually a litany of technologies that have gotten to the point where they're actually usable. So like ZK proofs are starting to get there. The baseline cryptography, just like, coming out of Ethereum, people don't realize this. There's a company called Spruce, which is an electric portfolio company. They power the California DMV app. And so you can like go through TSA on your phone with your driver's license. And they have deals with several other states and Department of Homeland Security. And you can actually go through like government facilities with this thing. And like the cryptographic curves that they're using literally are the same as Ethereum because the company started as sign in with Ethereum. Nobody knows that, right? They don't talk about that. But it's literally the exact same stuff. You look at distributed systems tech that you can just take like an SDK off the shelf. You look at things like Privy. So like everything just becomes, which is also an electric portfolio company, right? They're now a part of Stripe. That's just now like every app just becomes a wallet. You just have money sitting in your thing and you just move it around. You don't have to think about it, right? So like I think we're at like the very cusp, the very beginning of wallet tech, all the cryptography, the zero knowledge proofs for privacy, the distributed systems tech where I can just like spin up a distributed database and like store, have global state visible stable coins, are just starting to get, they're just protocols now and they just kind of work. And I think people are starting to figure out that we don't even need to lead with the crypto piece of it anymore. Let's just lead with the utility. So I think that like a good example of this right now is X402, where it's this protocol to pay, over the wire for API calls. And I think a lot of people don't realize that came out of Coinbase and sort of like a bunch of crypto people pushing on this. Cloudflare has now picked it up, and actually a bunch of people in the AI community are excited about it because this is how you could get agents to pay each other, right? It's actually an internet native way to be able to pay because what you do is you send a request to some API endpoint. That API just comes back and says, you got to pay me to do this thing. And here's how much you have to pay me. And here's how you pay me. And now because everything is stablecoins and wallets, you can just pay people, right? And so now you can pay for a little bit of data. You can pay for a little bit of compute time. You can pay for access to that one article over an API call. And that just wasn't possible before, right? And crypto makes all that possible. But the AI people are excited about it, and nobody talks about it as a crypto technology or crypto company. It's just like a thing that works. So I think we're actually there with a lot of these components. And so a lot of where we're spending time now is if you understand those technology pieces, what problems can you solve? And if you do it in the right way, you actually wouldn't even call yourself a crypto company. You would just go to market and say, we solve a problem. And everybody would be like, oh, that's awesome. Like, how did you do that? And then you would dig into it and realize that it's a bunch of crypto tech behind the scenes.
Guys, this has been great. I've learned a lot. There's so much going on in digital assets that I feel like I learn more every time I try to get caught up to what's going on in the news. But yeah, this has been a great conversation. We're running up on time here, though, so I'm going to try to land the plane with a question here. Jesse, I'd like to start with you. And, look, I asked you about AI, but if there are innovations that you are excited about, I'd like to hear that from you, too, because I know you spend a lot of time in the space as well. But the question I want to end on is, in the next 6 months, like short term, obviously we talked about some of these long-term changes that are coming. What's the next catalyst that you're looking for that's going to reignite retail and institutional interest in crypto, that's going to kickstart the bull run, bring the good vibes back? What are you looking for as the next catalyst here?
That's kind of hard one. I think it's incremental gains in liquidity and things, but I guess maybe you could say PAL going out could be a catalyst, and people build the narrative around that. Could be the market structure bill where people build the narrative around that. But I think it's more complex than just those would be market narrative catalysts. But the bigger picture is there's a lot of little things that kind of come into place in going into 2026 for everything to really take off. So stimulus checks, PAL going out. I don't know what's going to be like. Oh my gosh, retail's wanting to YOLO into crypto. Yeah, I'm really bullish on 2026, and I feel like I'm one of the few left that is, but I think it's going to win out in the end.
Well, me and Jesse with the last two bulls left.
That's the thing is I'm still bullish too. It's just like, all right, it might take a little bit. All right, but Avichal, what is the catalyst in your mind that you're looking forward to? Is it the Clarity Act? Is it Powell changing? Is it just this incremental build that we're seeing?
I don't think it's any one thing actually at this point. I think there's an old Ben Horowitz blog post that I remember reading when I was a founder, which is there's no silver bullets, there's only lead bullets. And once you sort of realize that as a founder, you're not like, there's not like one thing that you have to do and then all of a sudden your business works. There's just like one thing and then the next thing and then the next thing and then there's just a bunch of lead bullets. And I kind of think that's where the industry is now. It's not going to be like Clarity Act happens and then we win, or there's a new Fed chair and then like all the money flows. I think it's just like lead bullet after lead bullet, and then you wake up 5 years from now and you're like, holy crap, like everything worked. I think we're like right at the beginning of that. So I don't know how the next year plays out. I'm like not smart enough to call the markets, and it's none of this is financial advice. Nobody should ever listen to anything I say, but I'm pretty sure that like I see all the lead bullets that are about to get fired over the next 5 years, and it's like it seems pretty straightforward to me from there.
Guys, I really appreciate the insight on this, and thanks for being on the Milk Road show today. I hope our audience got a lot out of this. If nothing else, I think everybody should take away from this that we're becoming a real industry and not hype chasers, and there's a lot being built that is behind the scenes that's not making headlines. So take this opportunity to do some education, research, follow up on these things. Avichal, where can we send people to find more of you and your work online?
Just at Avichal on Twitter is probably the easiest, or at Electric Capital on Twitter is probably the easiest. We have all the .com, so electric.com, electriccapital.com, and developerreport.com. We try to do the .coms, so but we're pretty easy to find.
Jesse, what about you? Where can we send people to find more of you?
Same thing on X at Jesse Eckel.
Awesome. Well, guys, I really appreciate you coming on the Milk Road show. Stay bullish. We'll see you all in 2026 or hopefully sooner. But yeah, like take care of yourselves. Thanks for being on Milk Road show.
Yeah, thanks for having us.
Good to see you.
If y'all are making swaps or trades right now, highly recommend you check out Milk Road Swap. This is a DEX that we built in partnership with Cow Protocol. Why do we build it? Not to make money, just honestly so we could have a place to do our swaps for the lowest fees that we could find. This is the fees on Ethereum, Arbitrum, and Base are only 0.15% fees. This is a huge difference from other centralized exchanges that charge 0.5% or even up to 1.2% fees on their swaps. Also, you can swap on Solana, all at swap.milkroad.com. Check it out today. You won't be upset. And you can join me in my favorite place to make swaps on chain. Want insights on what's moving crypto markets and how we're trading each event? Subscribe to our channel and join the Milk Road Daily and Pro newsletters and start investing like the top 1%. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.